Good evening. We begin tonight as Wall Street fund managers have turned their noses up in disgust at Joe Biden's plan to raise taxes. President Biden's being accused of sabotaging economic growth, and the fallout's only just beginning. We told you last night about the plan to nearly double the capital gains tax for the wealthiest Americans, those earning more than $1 million a year. Now cryptocurrencies have tumbled and hedge fund managers are speaking out as Republicans are already vowing to oppose the plan. The rich cryptocurrency traders probably stand to lose under these proposals, and so crypto has lost more than $200 billion in value today. For instance, Bitcoin fell below $50,000 for the first time since March, a small recovery in the last hour or so. Ethereum, the other big crypto, is down 11% from yesterday's high. Jeff Zeleny is in Washington. Nobody should have been surprised. Of course, the president made it clear. But as these, the market rally that we are seeing today is because the market's saying, Jeff, they don't believe he can get these proposals through.
Richard, there's no question that this was not a surprise to anyone who was paying attention to the Biden presidential campaign and, just his overall posture over the first nearly 100 days of his time in office. But he is, really putting the meat on those plans. We're going to hear it next week when he addresses a joint session of Congress, and he is going to call for big tax increases, particularly on capital gains. But the question here is, how will these negotiations play out? And you're absolutely correct. One of the reasons that Wall Street is perhaps not quite as worried, they know that the plan is not going to end up, it's not going to be signed into law as proposed. Yes, Republicans are standing in lockstep against all of these tax increases. Of course, the audience that matters is the audience in the middle, those centrist Democrats. Joe Manchin, senator from West Virginia, who we talk about so much, his view on this will be absolutely critical. So just as we've been talking about the proposals to raise corporate taxes to pay for infrastructure, those plans also are yet to be determined. Same here with the raises proposed on capital gains taxes and others. But there's no question taxes will go up in some respect. The amount, of course, is to be determined, but almost certainly not to be end up like these proposals are beginning.
Right, but how much political capital do you estimate the president's prepared to spend? Now, bearing in mind he got through the stimulus, and that was a hefty push. There's infrastructure coming along. Is he prepared to spend capital, political capital, to get these tax cuts?
Richard, I think he's prepared to spend virtually all of his political capital, and this is why. Time is short for the Biden presidency. He realizes that this is the year to get big things done. So we will see, how many things get done. We'll see how big the things are that they, will ultimately get done. But the reality is he's willing to spend it. And what that means is, keeping together those narrow Democratic majorities, both in the House and in the Senate. So I think he's willing to spend it. The question is, how much are some of these moderate centrist Democrats willing to swallow here? And it is on the backs of the Joe Manchins, the Senator Kirsten Sinema from Arizona, senators like that will be key to all this. We know by now, watching the first 3 months of this presidency, the idea of bipartisanship, getting Republicans to sign on to this, it's not going to happen. So it is those centrist Democrats here, and in a very narrow majority here, the White House is not going to get everything at once. But I think he's going to go to the mat to get as much as he can.
Jeff, have a good weekend, sir. Thank you. Jeff Zeleny in Washington. Investors are fearing that the latest move on Pennsylvania Avenue could fundamentally change the rules of the game for Wall Street. So, anyone earning over $1 million a year in investment income pays a maximum of 20% in taxes on that income. It has been that way for years, that there is a lower rate of capital gains than there is for earned income. If Mr. Biden plays his cards right in Congress, those gains could be taxed at the top rate for wages and salaries. That's 37%. And the president wants to raise that to 39%. Players on Wall Street aren't happy with the plan. Anthony Scaramucci says it could have deleterious effects on jobs Creation? Tim Draper says it might kill the golden goose that is America. And the initial reaction was arguably overblown when we saw yesterday the president promised to raise taxes for months during his time on the campaign trail. So why was anybody surprised?
We need to go out and make it clear to the American people that we are going to raise taxes on the wealthy. We're going to reduce tax burdens on those who are not. We have to start rewarding work, not just wealth. I can pay for my whole health care plan by changing the way in which we deal with capital gains. People should pay their capital gains based on what their income tax is, and not at 20%.
Ben Axler's founder of Spruce Point Capital Management. Always good to have you with us to give us the view. Look, Wall Street knew this was coming. That's why we saw the sharp falls. But today's recovery, because what? You just don't think it's going to happen?
Well, I think that's right. I mean, the market's discounting that, you know, this is a starting point, right? But buying throughout a high number is a starting point for negotiation. But most likely, you know, it'll be walked back. I give the, you know, the headline rate he threw out as a 50% chance of passing. But the market's forward looking. The market's still looking at the easy, ultra accommodative, you know, Fed injecting liquidity into the market, and stock prices are moving higher as a result.
Is there a valid reason, in your view, in Wall Street's view, for taxing capital gains at a lower rate than income? I mean, I know it's been that way for 70 years. It's a canard of the taxation system. You have two rates of capital gains, a short and a long term. Would it be a big change if that goes?
I think it would. I mean, our view is that there's just too many taxes. You have taxes on wages, taxes on capital, you know, taxes on sales, taxes upon death, taxes upon buying real estate. You know, lower taxes are generally a good thing. The more you raise taxes, the less you're left with on an after-tax basis, and that means you have to take greater risk for seeking greater return to meet, you know, hurdle rates. As an investor, I look at, you know, a return on my capital, and if you raise my tax rate, I'm getting a lower return on my capital. There's also other negative side effects of raising tax rates. You're going to see an increase in more tax avoidance strategies, right? I mean, the wealthy want to do one thing. They want to protect their hard-earned capital, and so they're going to spend more money seeking ways to reduce taxes. So why not keep taxes low? I think taxes low is the best way forward. Somebody
and somehow has to pay for not only the last year, but also the infrastructure and the improvements. Now, I suspect you'd agree that it is in a fair society, the rich do pay more than others. I guess that's sort of a fundamental rule of the game too. But who do you think, or how do you think the pandemic and the infrastructure should be paid? Well, you know, I think, you know, the Treasury needs to thank the Fed. The Fed's been, as I said, ultra accommodative, and, you know, not just the wealthy, but even the middle class that owns some stocks have seen enormous capital gains in the past year just from following the Fed and buying stocks. So, you know, you're already going to get enormous taxes paid on those capital gains. Why, in addition to that, do we need to raise the tax rate as well? I think that's not clear to me. So I think these things can be funded with existing resources and within the existing tax framework. Ben, we're not going to let you go without getting some thoughts on the market and where we are as we get ready for an earnings season. Now, we had the one that went by was okay. It was okay, but as we look forward, until this latest bit of hiccup in the last week, the market was on a tear. Is it because the view is the US is going to recover so strongly by during the second half of this year? Well, I think it's more than priced in. I think the multiples are rich. I think, look, a lot of companies have structurally changed their business model through the pandemic. I mean, my business, for example, we've streamlined a lot of costs, taken out redundancies in our overhead, taken out real estate costs. A lot of businesses continue to allow their workforce to work remotely. So, you know, those are savings down to the bottom line, and some of those will be structural, you know, changes for the long term. But we think the market's more than fairly priced. We think investors should be playing defense. You know, we focus on short selling, so we think it's important to have a focused hedge book and have some downside protection here. But we're not extremely bullish on the market. We think investors need to be selective and need to play more defense than offense here in this part of the cycle.